Okay everyone, so in today's video, I really wanted to share some information that I've been learning about trading the stock markets, the currency markets, the crypto markets, the gold markets, based on what is happening with real interest rates. And when I say real interest rates, I'm talking about interest rates in the bond market adjusted for inflation. Because what I'll be showing you in this video is how this real rate of interest is having a massive impact on the demand for stocks, because the price to earnings ratio, which I'm sure you're aware of, is called a PE ratio, is being determined by the real rate of interest if you buy a government bond adjusted for inflation. I'll also be showing you how the cryptocurrency markets move in line with the stock markets. And if you can understand this correlation, it can really help you if you're trading cryptocurrencies. I'll also show you how this really has an effect on the currency markets and the commodity markets if you're trading gold. And I'm sure it's going to add a lot of value to your trading if you really understand this really important formula that all the hedge funds, investment banks, and professional traders are using. I really hope you enjoyed this video. And if you do, please like, comment, and subscribe, and let me know if this video has helped you with your trading. Okay, everyone. So welcome to today's webinar. Really going to touch on some really important concepts about understanding inflation and how interest rates really do drive all of the markets that we're trading at this moment in time. Okay, so what we're going to do, I'm going to give you a really good breakdown for how interest rates and central banks are affecting the currency markets, the crypto markets, the stock markets. And it's really going to drive home this message that you have to understand interest rates if you want to be trading. Okay, so I've broken down this whole entire concept for you guys in a lot of detail. So we're going to learn a lot tonight. And moving forward, you'll have a better idea as to why you need to pay attention to where inflation is, where interest rates are, to know what's happening in the markets. Okay, so we need to first of all understand, why do central banks have interest rates and how does it control inflation? All right, so central banks all around the world have a dual mandate. Okay, and the dual mandate, most central banks, is to control inflation around their target, and most advanced countries have a 2% inflation target, and their job is to maximize employment. Okay, now how they're going to do this is they're always trying to control inflation by controlling the money supply. And how you control the money supply is by implementing interest rates. Okay, and if you can implement interest rates, what you're trying to do is to make sure that you can control the spending of people inside the economy. Because think about it, everyone's in debt, everyone has a credit card, everyone has car loans, everyone has mortgages, and the interest rate set by the central bank is literally going to control people's spending. And if you control people's spending, you can hopefully control inflation to be around the central bank's target. That's where the theory lies of how you control interest rates using the money supply to control inflation. Okay, as you know, at the moment, inflation has been a big problem all over the world since COVID, and now central banks have been raising interest rates to try to wrestle down inflation back down to their 2% target. Okay, so when a central bank is trying to control inflation, they're doing it using the money supply. And how you implement the money supply being increased or decreased is actually through the implementation of interest rates. Okay, so a lot of you may not understand this, but when a central bank is raising interest rates or cutting interest rates, what they're actually doing is they're buying government bonds or they're selling government bonds to affect the price of the bond, to cause the bond to go up in value or down in value, because the interest rate on a government bond is fixed. So the day that you buy a government bond, however, whatever that rate of interest was, the day you purchase that bond, that is the rate of interest that you're going to be earning if you was to hold, for an example, a 10-year government bond. So let's say we bought the 10-year government bond in the United States, for an example. Let's see where that rate is currently right now. Today, the interest rate is 3.65%. Okay, so let's say you was to borrow the US government $10,000. You know, the day you buy this bond, if you bought it today, you get 3.65%. So you get $365 per year for the next 10 years if you held that bond until maturity. And maturity just means if you held that bond until the 10th year, you're guaranteed to get the money back from the government Okay, that $10,000 you borrowed them, but you've also made $365 per year over 10 years. So you'd make 3,000. You'd make around 300. I'm not quite sure how much 3.65% is exactly of $10,000, but you'd make a fixed amount on that bond that you've purchased. 3.65 divided by 100 times 10,000. Okay, you're making 365. Okay, times that over 10 years, you're going to make $3,650, which is a really good return over a 10-year period. Okay, so that's what investors are always looking for. They're trying to work out, how much am I going to get paid if I borrow the money to the government over a certain period of time? And this is a really important calculation if we're trying to understand the bond market. Not sure why this chart has not come up. That's a bit of a problem. So I want to walk you through this chart in a lot of detail. Let me just reopen this chart for a second. Sorry about that. I'm not sure what happened there. Let's just get this back up. Okay, there we go. All right. So what we're looking for is this. If you're borrowing money to a government, there's different time frames that you can borrow money to a government over. Okay, you can borrow money to the government over a 1 month period, a 3 month period, a 6 month period, 1 year period, 2 year, 3 year, 5 year, 7 year, 10 year, 20 year period. And the interest rate over different bond maturities, so different periods of time, is going to be based on what investors are expecting for inflation. So if I take you back to that spreadsheet, you can see right now in the United States, if you borrow money to the US government over 1 month, they're going to pay you 5.66%. Over 6 months, it's actually higher, 4.93%. 2-year government bond is paying 4.4%. In the next 10 years, if you borrow money to the government, you're going to get paid 3.63%. Okay, so you can see how over different periods of time, there's different rates of interest when you're borrowing money to the government. Okay, now why this is important is because you're always going to hear in the financial markets talking about the 10-year government bond yield. They're always talking about the interest rate on a 10-year government bond. And just so you know, yield, a 10-year government bond yield just means the interest rate on a 10-year government bond. And the reason this is really, really important is because mortgage rates, credit card rates, bank loan rates, when you borrow money from a bank, it's going to be priced off of the 10-year government bond. Okay. And when I show you how company earnings in the stock markets are also priced off this bond, you're going to see why this is so important to understanding the direction of the stock market, because it literally has a massive, massive impact. Okay. So stock market valuations, when you're looking at the stock market recently, as we've been seeing, it's been going higher. So the NASDAQ 100 in the United States has since September gone up by around 20%. It's had a big move. The S&P 500 since September has gone up by around 15%, so a little bit less than the NASDAQ. Why has the stock market gone up? And what I'm going to be showing you is all to do with the interest rate on a 10-year government bond adjusted for inflation, and that's having a big impact on the price that investors are willing to pay for the earnings of the companies within these indices. Okay, so you got the top 100 NASDAQ. So these are 100 companies in the United States. A lot of these are tech companies. Okay, this moves more than the S&P 500. The S&P 500 is the 500 largest corporations in America. Okay, so all you need to understand, when the stock market index of a country is going up or down in value, it is because investors are trying to figure out what price is an investor willing to pay for the expected earnings of a company over a specific period of time. The stock market is going up and down is basically the investors calculating every day, what's the earnings valuation? What should I pay for these earnings today for me to be able to get the interest rate, to get the earnings of these companies at a fair value, okay? And how they're doing it, how they're calculating what is the expected earnings of a company over a specific period of time is based on the real rate of interest, Okay, you're going to hear this a lot in Bloomberg TV, CNBC. They're always going to talk about real interest rates. I'm probably thinking, what the hell is real interest rates? What does that mean? Basically, what I'm trying to share with you now is the value of future company earnings is going to be based on the real rate of interest. And the real rate of interest is a 10-year government bond, the yield, the interest rate on a 10-year government bond adjusted for inflation expectations. Now, this is key. Expectations. Where do investors expect inflation to be going in the future? And that's going to determine, if you take that 10-year government bond yield at 3.64% and you minus the expected rate of inflation, you're either going to get an interest rate which is positive or negative, and that real rate of interest adjusted for inflation expectations are either going to be going up, so interest rates are more expensive, or it's going to be going down and interest rates are less expensive based on where they're expecting inflation to go. Okay, so this is very useful for investors because remember, they're always trying to figure out what is the value I should pay for the earnings of a company. Okay, and it's based on the real rate of interest. So the price you're willing to pay for the earnings of a business, what is the fair price, and how much did you pay for these company earnings today is calculated using a formula called the discounted cash flow model. Okay, and that discounted cash flow model that you're going to be using to calculate the earnings of a company is literally the 10-year government bond yield, the interest rate on the 10-year government bond, minus the expected rate of inflation. And this is the real rate that investors are using to calculate the earnings. What is the price I'm willing to pay today? Okay. And basically, if the real rate of interest is going higher, then these companies have a lower valuation. If the real rate of interest is going lower, then the companies have a higher valuation. Okay. So what we can see is this. If I take you to the spreadsheet, I want to show you something from 2022. In 2022, expected inflation over a 2-year period started to go low. It hit its peak and then it started to go lower. So can you see it reached 3.18%? And then what happened? It started to decline. Can you see that on the spreadsheet here? And over a 5-year period, inflation hit its peak in August. And then from September, it started to decline. And what happened in the bond market? Okay, when did 10-year government bonds hit their peak? So US 10-year bond yield. Can you see around September times, it hit its peak? So you can see here, this is the 10-year government bond on the right-hand side. This is the real yield. This over here is the 10-year government bond yield adjusted for inflation. And it hit its peak around the 28th of September. Okay, because inflation expectations started to go lower. So that calculation for what is the real rate of interest hit its peak in September. And look, it started to decline. Now, as it started to decline, what happened to the value of future earnings in the United States stock markets in September? So look, you can see over here on the top right-hand side, it hit its peak, but look at the two charts on the left-hand side over here. Can you see how this line lines up? Can you see when the real rate of interest started to decline because inflation expectations were going lower and the 10-year government bond yield, the interest rate on 10-year government bond started to decline? What happened? The calculation for the earnings of businesses started to increase because the real rate of interest was going lower. So companies had a higher valuation. And that is exactly why the stock market shot up 20%. Okay, can you see? Both stock markets started to rally when the real rate of interest started to decline. And if you look previously at these big drops in the stock market, when were they happening? No surprise. Look, when did the real rate of interest start to rise? November 2021. Look at both charts on the left-hand side. This is when the stock markets started to decline because the real rate of interest going higher means that the valuation of the future earnings of companies were going lower. It was worth less. You can go online, you can do the research of the calculation if you want yourself, but you don't need to, okay? Because all you need to understand is that the price investors were willing to pay for the earnings started to decline. So look, when the stock markets were at their peak, the real rate of interest was very low at that time. Can you see? It was very low. And stock markets had been going higher at that time. All last year, look, it was on its way up. Stock markets were on its way up. And then the real rate of interest started to rise and stock markets started to decline. And in the bottom right-hand corner, this is called the PE ratio, the price investors are willing to pay for the earnings of the S&P 500. So we're looking at this stock market here. And look, when did the PE ratio hit its peak? Hit its peak around this time, then started to decline. You can see that the earnings, the price investors willing to pay for the earnings started to decline. And when the price of the earnings start to decline, the stock markets are on their way down. You can see over here. Can you see that? Why did inflation expectations start to drop in the United States around September? Well, no surprise. When did inflation have a third month in a row of falling? By September. It hit its peak in July, and there was 1, 2, 3 reports of inflation falling for investors to finally have the confidence to say, okay, we've had 3 months in a row now that inflation is going lower. We believe that inflation is going lower. And when the expectations of inflation started to decline, the real rate of interest started to go lower and stock markets started to rise. And that's why stock markets are on their way up right now. Because if you go to 2023, the situation has continued. Inflation has continued to go lower and inflation expectations have continued to decline. Okay, and in their surveys where the central bank does their own surveys and the private sector do their surveys, expectations of inflation are on their way down. So look, if I take you back to this spreadsheet, can you see here, look, inflation expectations were at 5.2%, for an example, and look, the expected rate of inflation over 1 year and 5 year period since then has gone lower in the two spreadsheets. Okay. So this is really important for us to understand because it gives us an idea as to how investors are looking at the forward earnings valuations of companies by looking at the 10-year government bond yield, where is inflation expected to go? And then that's going to affect the price they're willing to pay for the earnings. And that PE ratio I just showed you has been on its way. It was on its way down, but look what's happened recently. Can you see this bounce higher since September the 30th? Can you see when the PE ratio started to rise? So the price investors are willing to pay for the earnings started to go higher. No surprise. Look, exactly the same time. That's when the stock markets went up. And look at the top chart. That's when the real rate of interest has been declining. So the more inflation keeps coming down, the more the expectations of inflation are going to fall. And then the price that investors are willing to pay for the earnings is going to increase. And the price increasing means that the earnings are more desirable. Investors want to buy the company now. And think about it. If these earnings go all the way back up to 40, for an example, wouldn't you rather buy stocks now and get in at a very low price and catch the whole move higher in the stock markets? Of course you want to. That's why I'm buying stock markets right now, because I'm watching this economic data that I'm sharing with you guys. Okay. So we have to pay attention to where is inflation right now? Is it rising or it's falling? Right now it's falling. Where is inflation expected to go? And at the moment it's falling back towards the central bank's 2% target. So what are markets expecting from the central bank? Well, the markets have been expecting that the US central bank is going to cut interest rates. And if they cut interest rates, that's going to have a big impact on the US dollar. Sorry, on the real rate of interest. Because if markets are expecting the central bank to cut interest rates, then that 10-year government bond yield, that interest rate on the US 10-year government bond is going to decline. So it may be at 3.6% now, but it may go down to 3%. It may they're going lower, back down to 2.5%, for an example, back down to 2%. And what's going to happen to the real rate of interest is going to decline massively. Because remember, the real rate of interest is a 10-year government bond adjusted for inflation expectations. And if they're both falling, that just makes the earnings of companies more valuable, and that pushes up the stock market in the United States, as our example. Okay, so this really has effect on the stock markets. And if you know anything about the crypto markets, you know crypto moves at exactly the same time as the stock markets. All right, so let me take you over and show you Ethereum for an example. Actually, you know what? Let me show you something even better than that. When has Ethereum's price started to rise? Just so you can see the correlation. Ethereum's price started to rise when? Or it bottomed at exactly the same time when the stock market's bottomed. So look, Ethereum had been dropping all year. Bitcoin dropping all year at exactly the same time as the stock markets have been dropping. But then what happened? The real rate of interest started to go lower. The PE ratio started to go higher. And when the stock markets started to rise, no surprise, crypto markets rising. Look at exactly the same time. Look at the chart above. You can see exactly the same time. And I'll show you throughout history right now on the chart. I'll show you how this is not just something new. This happened throughout the whole of last year. Look, if I show you, last year, 2022, crypto was on a big bull market. Bitcoin was going up. Ethereum was going up. Why? Because stock market was going up. Why do they move together? Because investors, when they're buying crypto, they're buying stocks. Why? Because crypto move at a faster pace than stocks. So investors would rather get into the crypto market, or some investors, than the stock markets, because you get bigger returns. Look, in 2021, for an example here, the NASDAQ went up 33%. That's a big return, right? How much did the crypto markets go up? Ethereum, for an example, 500%. Now, let's say you're a hedge fund with $10 billion and it goes up 500%. If you invest in crypto, you just turned 10 billion into 50 billion. Well, the difference is if you bought the NASDAQ, nowhere near. You wouldn't have even doubled your money. So you can see that's why when investors are confident to put their money to work in a bullish environment, and an environment which is bullish, it basically means investors are confident to put their money into risk assets, and risk assets are stocks, for example, because they're quite risky because they fluctuate aggressively. That's why there's putting markets in their money in the stock market. So you can see, look, when the stock markets had a pullback here, look at crypto. Exactly the same time, crypto pulled back. Stock market started to go up again. We had another pullback here. What happened? Crypto had a pullback at exactly the same time. Then what happened? Stock market started to go up again. So the crypto, we had another little pullback in the stock markets. Exactly the same time, crypto pulls back. Stock markets peaked, crypto peaked, stock markets collapsed, crypto collapsed. Okay, so if we're going to understand how to get into crypto, all we have to know and understand is exactly what I just showed you about expecting to know where the stock market's going to go, because they move in correlation. That's why I'm back into the crypto markets now, because the stock market is starting to rally higher. And if inflation keeps falling and inflation expectations keep falling and the PE ratio keeps rising because the real rate of interest keeps going lower, perfect. We can trade both markets. Okay. Now let's understand the currency markets, because interest rates literally drive the currency markets. Okay. So as I'll show you, and I'm sure you're aware, in 2022, the US central bank started to raise interest rates. They started raising interest rates around March. So interest rates in the US really took off, and they took rates higher aggressively to fight off inflation. They had to. Inflation had been out of control and they was too far behind inflation to catch up. When they first started raising rates in March, inflation was already at 8%. Okay, so the central bank had to do something. So the US central bank was raising interest rates. Okay, so the government bond yields in the United States were going up. Of course they were, because interests are going up. Look, in 2022, when the Fed started raising rates from March, look, March is when the bond yields really took off. And what do you think investors are looking to do? They're trying to park their money in any country with the least amount of risk to get the highest amount of interest. So they put their money into countries that pay the highest amount of interest. So who owns the most US debt? Japan does. Japan is the #1 owner of United States debt. So when the Fed was raising rates in 2022 to fight off inflation in March, What was Japan doing? Nothing, because inflation in March was at 0.9%. Japan has had a deflation problem for over 30 years. They can't get inflation to their target sustainably. They've failed to do it since I've been alive. Okay. So Japan's central bank wasn't raising interest rates. They have no reason to, but the United States was. So what happened to the dollar against the yen? Well, just think about it. As rates in the US are going up, and this is just the difference between US rates and Japan rates. That's a calculation. Anything above zero on the left-hand side is the US paying a premium rate. And the blue line is the difference between the two. As the blue line was going up, meaning the US is paying more interest than Japan, what do you think Japanese investors are doing, guys? They were just taking their money out of Japan and putting it in the United States because they are the #1 holder of US government bonds. Why? Because they can't invest in Japan because they're not getting any interest. So what happened? This happened. Boom, big moves in the USD JPY in 1 year. You see how the interest rate differential pushed up the currency pair? 39% in 1 year. There you go. Why did Euro USD fall for the whole of last year? Because the US is paying higher interest rates than Europe. What do you think European investors were doing? Putting their money in the United States. You know, because they couldn't get the higher rates in Europe. That's why the US dollar strengthened against the euro by nearly 20%. The European Central Bank did start raising rates, but way after the Fed did. They only started in July. So the central bank in the US was way ahead of them. Okay. And it caused the dollar to strengthen against the euro. It caused the dollar to strengthen against the Japanese yen. Okay. And if I show you spreadsheets, you can see the blue line and the currency pair, they follow each other. Interest rates drive the currency markets all day, every day. This is literally driving the currency markets when you're looking at currency pairs. Okay. And then there's another thing you have to understand, and that is called the overnight carry trade. So when you're a currency trader and you're betting on currencies to go up or down in value, you need to understand where investors are putting their money in the most intelligent way. Okay, so rates in the United States right now are 4.45%, and rates last year were going up. So if I open up a trading account and I put my money in the brokerage account and I sell the Japanese yen to buy dollars, the interest rate differential between the two countries is right now 4.85%. And as that interest rate was going higher and higher in the United States, investors were understanding that, of course, money is coming out of Japan and into the US. So what do you think they're doing? The currency traders were catching that trend. They were getting in early and catching a 32% move. And by the way, probably entering multiple positions on the way up. Okay. And then on top of you making that 32% return, what you need to understand is, depending on the lot size you're taking in the trade, you could be earning, for an example, $14,000 a year over 365 days as free credit being credited into your trading account by your broker. Because the interest rate differential between two countries depends on whether the broker is paying you interest into your account based on the size of the trade you're taking, or debiting money from your account, and you'll have to actually lose money. Because if you sold the dollar to buy the yen, because you're paying more interest on the dollars that you borrowed compared to how much interest you're getting paid on the dollars, on the yen that you purchased, which is nothing, what happened? You're losing money every day. So no trader in their right mind is going to take that trade. They're going to take that trade all day in the dollar's favor. But look what's happened recently. Why has the market started to sell the dollar? Because inflation's falling and the markets are pricing in interest rate cuts. So if those interest rate differentials start to narrow, let's say rates go down to 3% in the US, look at that 14,000 you was earning. Now, how much does that turn to? Now 8,000. Big difference. So what do you think investors are doing? Cashing in and closing their trades quickly before that 32% return turns into only a 14% return. If you're a big investor with a lot of money, that could be a massive loss that you make. So if everyone cashes in at the same time because they're expecting the US Central Bank to cut interest rates, now the trend reverses. That's why the yen is getting stronger against the dollar. That's why the euro is getting stronger against the dollar, because the currency markets are also driven by interest rates. All right. So can you see just how much of a big impact interest rates are having on cryptocurrencies, Forex, and the stock markets? Okay. This is really, really important for you guys to understand, because it'll really help you when you're trying to trade, if you actually can understand, okay, what is actually going on in the markets. Do any of you have any questions you'd like to ask me about this before I move on to the next stage of this webinar? No? Well, I'm sure questions will come through as we finish off. Okay, so look, this is what drives markets. And if you don't understand how to have a system in place, which is what all these spreadsheets do, they give you a system to follow, to know what to look out for, to give you the green light to buy a currency, to give you the green light to buy the stock markets or to sell the stock markets. If you don't have this data and you don't know how to process it in a systematic way, it can become very difficult to trade because you don't even know why the markets are moving. And then you start just gambling and taking technical analysis trades, and it gets very, very difficult. You end up losing, you think trading doesn't work, and it's not that it doesn't work, it's just that you just don't really understand what's going on. Yeah, I'll touch on the Swiss franc after. Okay, so I have 2 courses, guys, for you if you're interested in learning this for yourself, okay? Because if you want to learn how to fish for yourself, you're going to need to understand. So I got a 24-hour special offer for everyone coming on this webinar. I'm going to give a £500 discount on my Forex and commodities course and on my stock market and crypto course. Okay, so you can get both courses for only £1,000 instead of 1,500. Or if you want to buy all the courses instead of 2.5K, it's now only going to be £2,000. Okay, and all the videos are in here for both courses. This is currencies, spreadsheet downloads. Okay, and you've got a stock market course here again with spreadsheet downloads as well in the members area. All right, and you get mentoring from me for 3 months, and this will really teach you how to trade properly if you really want to learn how to fish for yourself and get into investing. Because if you learn this, guys, you'll have a lot of confidence in yourself because you're going to learn how to make money with money. Instead of you going to work and working all day and exchanging your time for money, you're going to know when to put your money to work in the markets in a way which makes sense and you're not just gambling. All right. Also, and you get 3 months free access into the Telegram channels with all the other course members as well. So you can follow my trades, you get updates and a lot more. So this will really help you. All right. Someone asked about the Swiss franc and the US dollar. Same thing. The Swiss franc against the US dollar, which is the exchange rate here. If you want to know where this currency pair is going, I'll literally just show you this spreadsheet here. USD Swiss franc, here you go. It's being driven by interest rates. This is the history going back 2011 to today. So that's like nearly 12 years of data. Look, you can see the blue line is causing the orange line, which is the exchange rate, to move. So that's all you got to understand. All right. So I hope this webinar was really impactful for you guys. I'm going to upload it and put it on my YouTube as well. So please look out for it. Subscribe to my YouTube channel. And again, I'll do some more webinars shortly. Okay, guys. All right. Thanks for joining, and I'll do another one shortly.